Hey there, Mark Sedlock with Trade by the Numbers. I put together a special lesson for you all today. It's a lesson I did about 3 years ago, and it was very well received. So I've just revamped it a little bit, and I've included some more current information based on the way that I'm trading today. Basically, it's a mindset. It's a trading mindset, and one that you must adopt if you're going to become successful in trading. So with that said, let's go to the lesson.
All right, before we start on today's lesson, let's walk through the painfully obvious disclaimer. So this is for educational purposes only. Past returns are no indication of future performance. So let's go ahead and get started here. So first, I just want to thank you guys for spending time with me here. And in return, I'm going to make sure that I provide you a massive amount of value. My goal is that you'll be able to take some of the lessons from today and implement it into your trading immediately. Really what we're going through today and then in future lessons is really, it's a mindset, guys. It's a different way to look at the market. So one of my favorite phrases is, when the student is ready, the teacher will appear. So think about this. If you already think that you know everything, then there's no room for you to be taught. This is where my struggles began, personally. My ego was in my way. I thought that I knew everything. I thought that my prior successes would translate into trading success, and it didn't. This attitude cost me a ton of money, and most importantly, it cost me a ton of time. So over the next several lessons, I'm going to show you the exact steps that I took to go from a struggling trader to a consistently profitable one. So let's get started and show you guys what you can expect over the next several weeks. We're going to start with the first lesson, and that's going to be all about market structure. And the goal here is to help you stay on the right side of the trend and develop an objective way to determine that trend. This is one thing that changed my trading. When I started thinking in terms of probabilities and what was the likelihood of an event happening. In lesson 2, we're going to talk about my favorite lesson from the couch. So many years ago, I hired a professional trading psychologist, and I'm going to walk you through one of the lessons. I'm going to give you a quick hint, confirmation bias, and why it is effing up your trading. Honestly, this one thing saved my trading career. And then finally, we're going to walk through the only holy grail in trading, risk versus reward. So this is what gives me a massive edge in the markets. All right, let's get started. So today we're just going to scratch the surface. We're not going to go into lesson 1. That's going to be done in a webinar format so that you guys can ask questions in a live environment. But today we're going to walk through just basics. What moves the market? How I read market structure. How to identify if a market is trending or moving sideways. What is support and resistance? And then finally, looking at a blank canvas, which is just a price chart, versus looking at probabilities. All right, so let's start with the most basic thing first. What moves the market? The market is no more than just an auction. Okay, so for those of you who have taken an economic class, you might recall a discussion on supply and demand for goods. So when demand is greater than supply, prices will rise until they reach a point where the demand diminishes. So let's look at an example of an auto auction. Imagine yourself in an auction. First car comes out. It's at a really low price, so everyone puts their hands up. Price goes higher, you have fewer people putting their hands up. This is an example of demand and supply, right? So you have less demand as prices go higher. Okay, now let's look at the other side. So when prices are too high, the demand will come down, driving prices down. So an example of that is going to be the 2008 housing bubble. We ended up with an oversupply of goods, houses. Prices had to come down. And they came down until buyers decided those prices were a good value, and they started buying them back up. And then when buyers and sellers agree on price, well, this is when we get no trend in the market, right? Price just moves sideways because they're in agreement. All right, let's talk about the different directions There's just three directions: up, down, or sideways. Okay, so let's just look at what an uptrend looks like. So this is just going to be a classic bull trend. We're going to start with the downtrend, and then what we're looking for is we're looking for price to move through the structure from the downtrend. And I call that an initial thrust, an impulse move. So we're going to break through that, and we're going to create a higher low, a higher high, and then at this point, I'm going to say the uptrend is confirmed, and we're going to look to buy. All right? This looks simple in practice. I know in a live market, it's going to be a little more difficult. Let's take a look at a live chart. Oh, well, and the market puts in another higher low and higher high. Okay, so now let's look at a live chart. So here is the structure from the prior downtrend. We make a higher low and then a higher high. At this point, the uptrend is confirmed. And now we want to be buyers. So you can see from there, the market continues putting in higher highs and higher lows. Now let's look at the other side, the downside. We have the structure from the prior uptrend. We have our thrust down, our impulse move. We make a lower high, a lower low. Downtrend is confirmed, and the market makes another lower high and lower low. And then again, here's a live example. Here's a structure from our prior uptrend. Here's where we put in a lower high and a lower low and confirm the downtrend. You can see the market continues to move lower, putting in another lower high and a lower low. So here's what's important here, guys. How do you determine those structure points to use? So what I found is I actually implemented an indicator that helps me identify them in an objective way. This is something I'm going to show you in the upcoming webinar and give you all the rules for this. This will help you identify trends and spot areas for trading. Now, before we move on, let's just look at a sideways example. So how many of you have tried to trade this type of market with a trend trading system? So the key here is to understand how your system behaves in all types of environments: uptrends, downtrends, and sideways. This allows you to manage your expectations. Trend traders shouldn't expect to make as much money or any money in a sideways market as they would in a trending market. All right, so now let's move on and start discussing some other important elements. Support. At its most basic thing, it's just a price level where you can tell buyers stepped in, and when price comes back to that area, we would expect buyers to step in again. Now, at this point, if they do, then we say support has been confirmed. If they blow through it, then that support is gone, and once support is broken, you can look for it to become resistance. Let's look at an example. You can tell at this point, buyers stepped in a big way, hence the move up. And then price comes back to it, we test it right here, and then we move higher. This is an example of support being confirmed. Now let's look at the opposite example of resistance. It's just the opposite. It's where you can tell sellers have been selling, and when price comes back to it, you would expect it to either be confirmed, at which point sellers would step back in, or push through it, at which point resistance is gone, and then look for it to become support. Here's an example. Clearly we can tell sellers stepped in. Even in the midst of all this buying, you can see sellers confirm this area, pushing price lower. The real key here is on any given chart, it's easy to find places you want to trade from. But you must have an objective set of rules. Otherwise, you're going to end up over trading and blowing your account. And most importantly, if you don't have rules, how do you improve a bad system? Because you can't improve something that you can't measure. If you don't have rules, there's no way to measure where you're going wrong. Now let's take a look at a blank canvas. All right, this is just a blank chart. As you can see, there's a lot of areas we could be buyers. We could buy here. We could buy here. We could buy up here. The question is, how do we interpret this chart? So let's look at this from a standpoint of we don't have any rules. We're just analyzing market structure. We have a higher low, we have a higher high, and based on our prior analysis, we determine that this is where we confirm an uptrend. Here is the market structure zone. We would look to be buyers when it comes back in here. You can see that worked out pretty well, didn't it? Price came in, created another higher low and another higher high, creating a new zone. Well, now if we want to be trading this zone, we would have taken a loss here, a loss here, a loss here. So the real question here, as we're looking for trades, the real questions are, where's your entry? Where's your stop? Where's your target? What is your risk? Look, if you can't answer these 4 questions, I urge you to stop trading immediately because you're just going to blow your account. So now let's analyze this from a different standpoint. We're going to analyze this based on the way I see it, with probabilities. So this area right here, based on an objective set of data, is considered an LCP zone, or last confirmed pivot. And what this tells me is this is where I want to trade. And the way I would trade this, well, I'm gonna be trading this once I get what I call signal bars. Right here's a signal bar, right here's a signal bar, and right here is a signal bar. So as price comes back in, I'm taking trades, right? Now, this one right here would be a winner. This one, a loser. This one, a winner. But guys, the most important thing here is that I know what my entry is. I'm not guessing. I know that when price comes back here, I know what I'm waiting for. I also know exactly where my stop is. I'm going to look at the volatility in this market to determine how much room I have to give price. I use volatility because it makes it dynamic. It makes no sense to have the same stop in a volatile market as I would in a market with low volatility. I know where my target is. Again, the same principle applies. It's based on volatility. My risk, 1% of my account. So if I'm in a volatile market and my stop has to be wide, and that requires me to risk more than 1% of my account, guess what? I'm not trading. And my reward, 5% of my account. Guys, this is my edge. I have a massive reward to risk. Okay, let's go through what we learned today. We talked about market structure and how to identify a trending market versus a sideways market. We talked about support and resistance. We talked about trading a blank canvas versus trading with probabilities. Guys, think about it. If you're a painter, is it easier to paint with a blank canvas or paint by the numbers? Guys, the market's the same. Either you can trade with a blank canvas or you can trade by the numbers. This is exactly how trade by the numbers was born, because this is the way that I see the markets. So gang, look out for the webinar registration where we're going to really dig into this, because I'm going to teach you guys exactly how you can do this in your own trading.